An introduction to Indian financial system. So in this session, what we are going to do is we are going to say what is a financial system. We'll go through some of the definitions of the financial system and classifications of the financial system. So first, what is a financial system? So financial system are basically related services or activities where it comes together to achieve certain common goals or purposes. So the term financial system conveys that it's a set of related services or activities where it all comes together to achieve certain common goals or common purpose. That is financial system. Now it does mobilization of savings. So it creates an environment in a place, country, where it mobilizes savings or basically favors the savings habit of people and society. So whether it is mobilization of savings or the efficient, equitable and effective allocation of investments, finance acts as a bridge between the present needs and future needs of the society. Now, next is it does efficient, equitable and effective allocation of investments. So that we mean to say influencing savings, growth and investment capital formation. Indian financial system includes different markets, institutions, instruments, services and its different mechanisms of financial sectors. So it does efficient, equitable and effective allocation of investments. And then in Indian financial system, voluntary and market-based decision making can be obtained, which leads to economic transformation. So there is a voluntary decision making which happens, market-based decision making which happens, which basically leads the Indian financial system to economic transformation. And this point we actually have told it includes different markets. So that's a financial system. Next, we'll see some of the definitions of financial system. So there are two persons who have said about financial system. There are a lot of people who have said about financial system, but in particular there is Robinson and also a person by the name of Goldsmith. So first we'll see what are the definitions of financial system which were given by Robinson. So Robinson has defined the primary function of financial system as a link between investments and savings, so that it permits portfolio adjustments in the composition of existing wealth and provides a link between investment and savings for the creation of new wealth. So from Robinson's definition, the primary function of financial system is in the mobilization of savings and their distribution for investments in the industry, thereby stimulating economic growth by accelerating capital formation. The process of accelerating capital formation depends upon savings, finance, which is offering loans, and investments in financial instruments and services, financial institutions, and markets. It also goes without a question the importance of supervisory control and regulations when one introspects financial system, in particular the Indian financial system. Thus, it can be said that financial management is an integral part of any financial system. So those were Robinson's definitions. Next, we'll take a look at what is Goldsmith's definitions or the hypothesis which was put forward by Goldsmith. So according to a hypothesis by Goldsmith, there exists empirical evidence for separation of savings and investments in a functional form of creation of financial institutions and its mechanism of financial instruments, as well as enlargement of financial assets, increasing efficiency of investments, raising ratio of capital formation, so that the two channels are formed in form national production and financial activities, increasing the rate of growth. So this was the hypothesis which was forwarded by Goldsmith. So which actually told that there exists empirical evidence for separation of savings and investments. So financial institutions decide or see that there is a separation of savings and investments. It comes as two channels, and its mechanism of financial instruments as well as enlargement of financial assets increases efficiency of investment, raising ratio of capital formation. So investments raise capital formation, so that the two channels which we actually see, savings channel as well as investments, are formed in form national production and financial activities, increasing the rate of growth. Now, this rate of growth is what actually gives hints to the next question. So, what is the interrelationship of the rate of growth in diversified segments of economy? So, this rate of growth is impeccable in diversified segments of the economy, and their interrelationship can be illustrated. Now, how it can be illustrated? So, in a modern economy, a financial system provides essential services. The use of widely accepted medium of exchange, which is stable, reduces the cost of transactions. It no matter facilitates trade, because cost of transactions, when it is reduced, there will be a lot of transactions, and that means trade is actually promoted, which improves specialization in production. Savings in financial form is encouraged by financial assets with attractive yield, risk characteristics, and liquidity. So savings also goes up. Financial intermediaries increase the efficiency of resource usage whenever they evaluate alternate investments by monitoring the activity of borrowers. When the savings goes up, bank gets more money, they will actually lend it or to borrow. They will act as borrowers, they will lend it to borrowers. So the activities of borrowers also goes up. Now, an economic agent may price, pool, and exchange risks in the market, and it is enabled in most cases by an access to a variety of financial instruments. So, trading, which is an efficient use of resources, one way savings and risk taking becomes cornerstones of a growing economy. So, whenever trade is bolstered, trade is improved, trade is encouraged, it basically makes savings and risk taking a common activity in a growing economy. So with the help of an active supporting financial system, a country could make this feasible, and hence financial system is identified as the most catalyzing agent for economic growth and acts as one of the key inputs of development. So that is basically what is the relationship between rate of growth in diversified segments of economy. Next, we'll take a look at the classification of the Indian financial system. So Indian financial system can be classified as organized sector and unorganized sector. So before discussing that, we should also be aware of another classification of financial services, which is divided into users of financial services as well as providers of financial services. So there is a classification there. Financial institutions are users of financial services because they sell services to household, business, and government. Commercial banks, merchant banks, insurance companies, and investment trusts and mutual funds may be some of the providers of financial services. So that classification also exists. Now we'll actually discuss what is an organized sector, which is a classification of Indian financial system. We have seen that it is classified as organized sector and unorganized sector. So we'll see how Indian financial system, or in the organized sector, how things work. So organized Indian financial system. So here there is a range of financial instruments along with a well-developed money market and capital market with an impressive network of banks make organized Indian financial system work. So there is a range of financial instruments along with a well-developed money market and capital market. We'll see in a bit what is money market and capital market. Alongside an impressive network of banks, there is a network of banks also, which makes the organized Indian financial system work. Now, cooperative and commercial banks provide short-term funds. 9/10 of such banking business is controlled by less than 28 leading banks, many of whom have gone through mergers or consolidations. Now, in addition to commercial banks, so to take that point again, 9/10 of such banking business is controlled by less than 28 leading banks, which is again the number is less because they have gone through mergers and consolidations. So 9/10 of the banking business is controlled by less than 28 leading banks. In addition to commercial banks that exist in the country, there is in existence a network of land development banks and cooperative banks at state, district, and block level. So that also exists in the organized Indian financial system. So in the organized Indian financial system, it is estimated that there is around 2/3 share of total assets in the entire Indian financial system. So 2/3 share of the total assets in the entire Indian financial system is in organized Indian financial system. Many Indian banks in organized Indian financial system have diversified into areas such as leasing, factoring, merchant banking, and mutual funds. So in short, what we are telling is that in organized Indian financial system, it comprises of cooperative banks, development banking system in public sector, development banking system in private sector, money markets, financial companies, and financial institutions. Recently, the Indian financial system has developed into three areas, being cooperative, state, and private. The rural and urban areas are serviced by cooperative sector along with cooperative bodies with a national status. So that is basically a gist of what is an organized Indian financial system. Next, what is an unorganized Indian financial system? So unorganized Indian financial system consists of money lenders, pawnbrokers, traders, landlords, indigenous bankers, etc. Even though Reserve Bank of India does not control the unorganized Indian financial system, which may comprise of a host of chit funds, financial companies and investment companies, but everything is governed by rules and regulations and therefore under the gambit of the monetary authorities in India. So even though we say it is unorganized Indian financial system, it also is governed by rules and regulations and it is under monetary authorities in India. Next, we'll see what is Indian banking system. Indian banking system is due to spread of banking habits and development of economy, which is a very straightforward statement. Normally in India, the structure of the banking system is determined by economic factors and legal factors. So by economic factors and legal factors. Now, banking regulations by their very nature can be categorized into two types, namely regulations that result in new banks. So new bank regulations are regulations which result in new banks and which is by way of legislation also affects a bank structure, which is the legislative regulations. So banking regulations may be new bank regulations and legislative regulations. And the next by way of legislation affecting a bank structure more due to mergers, nationalization and liquidation. So all this affects a bank structure, which is again due to mergers. There may be mergers of banking systems, nationalization of banks, of existing private banks, it can get nationalized. And there some banks also may liquidate. So there is a liquidation also which may happen, which affects the bank's structure. Now, next is government regulations, which are a direct result of national objectives and aspirations, and it no doubt has a lasting influence on the banking structure. So that is Indian banking system. Now let's see what are banks in Indian banking system. There are actually a lot of banks in Indian banking system, but we know that the central bank of India, of our country, is actually the Reserve Bank of India. So that is Reserve Bank of India, which is the central bank of India. We also know there are cooperative sector banks. There are primary cooperative credit societies. There are central cooperative banks. Then there are state cooperative banks, land development banks, money market and capital market. So this makes up the Indian banking system. We'll go through each and every of them in a very brief manner. Reserve Bank of India, as we all know, is our central bank of India and heads all banks in the group of commercial banks, which may further be divided into scheduled and non-scheduled banks. So Reserve Bank of India heads all banks in this group of commercial banks, which may be divided into scheduled and non-scheduled banks. Commercial banking system happens in both private sector and public sector. Since some of the private sector banks are new banks that have sprung up recently. Cooperative banks included in the second schedule, foreign banks in India and other non-scheduled banks also comes under. Some of the public sector banks are SBI, nationalized banks, regional rural banks, etc. So that is Reserve Bank of India, which is our central bank of India. Now next is cooperative sector banks. So in order to replace the village money lender, cooperative banking sector has been developed in the country, where one should know that the village money lender was the only source of rural finance until cooperative sector banks were developed, as the terms in which the village moneylender made money lending was damaging and at exorbitant rates. So although the sector banks receive concessional finance from the Reserve Bank of India, so cooperative sector banks receive concessional finance from Reserve Bank of India at concessional rates, the rules and regulations exist and the governance of this sector is by the state legislation. Next is from the perspective of money market. Okay, in cooperative sector banks, from the perspective of money markets, cooperative sector banks are said to lie between organized markets and unorganized markets. Next is primary cooperative credit societies. So an association of borrowers and non-borrowers is what makes the primary cooperative credit societies. Societies' funds are from deposits of members, from share capital, as well as from central cooperative banks. The borrowing power of the primary cooperative societies and of the members are at a fixed rate. The loans given to members are used by the members for the purchase of fertilizers, pesticides, and made use of in the purchase of cattle and fodder. So that is primary cooperative credit societies. Next is central cooperative banks. So what they are? Central cooperative banks are federations of primary credit societies in a district, and they conduct the business of a joint stock bank. That is central cooperative banks. Next is state cooperative banks. State cooperative bank is a federation of central cooperative banks and lend money to central cooperative banks and societies, but do not lend money directly to the farmers. It acts as a watchdog of the cooperative banking structure in the state. The funds for distribution as loans are obtained from share capital, deposits, loans, and overdrafts from the Reserve Bank of India. So that is state cooperative banks. Next is land development banks. Land development banks meet the long-term credit requirements, which is basically what the land development banks do. It meets the long-term credit requirements of the farmers for development purposes. It is organized in 3 levels, namely state, central, and primary level. It provides credit to farmers for purchase of equipments like pump sets, tractors, machineries, fencing purposes, reclamation of land, well digging, etc. Land development banks are cooperative institutions and they lend money as loans based on the security of farmers' immovable property. So that is land development banks. Next is money market. So what is money market? Money market is to do with the supply and demand of funds that can be invested. It is the sum total of all the short-term funds available in the market. It provides a mechanism whereby short-term funds are borrowed or let out. There is a detailed session dedicated to discussing money market, and we will discuss money market then. And finally, it is capital market. So what is capital market? It is where long-term and medium-term financial needs of the business is met by financial institutions. So these institutions in turn are classified as development banks and investment institutions on the basis of financial mechanisms adopted and the nature of their activities. Investing institutions is made up of those financial institutions who collect the savings of people and offer people their own shares and stocks, which provide the much needed long-term funds by corporations, especially in the form of direct investments in securities or by way of business enterprise the way in which they underwrite capital issues. There is a detailed session available where we discuss capital market mechanisms. So we will discuss capital market in that section. So this completes an introduction to the Indian financial system. Thank you.